All right, everyone, we're going to go ahead and get started. I'm Emily with Broker Online Exchange, and I'd like to welcome everyone to April's Energy Market Intelligence webinar. If it's your first time joining us, we're glad to have you, and if you were with us last month, then welcome back. I'd like to start off again with a quick poll just to get a feel for who our audience is today. So take a look at the question and let us know what your role is in the energy industry. Thanks, everyone. I'm going to go ahead now and turn it over to our Energy Market Analysts, Catherine Riley and Joe Prozac.
Thanks, Emily. Hey, everyone. This is Joe and Catherine from the True Light team. Just to briefly introduce myself, because this is the first time that I have been speaking with you all. My name is Joe. I've been in the energy industry for a couple of years now. Originally started out at a retail supplier that was selling electricity in Midwest and even gas markets as well. But since I've been working at Genscape for the last couple of years as a power market analyst forecasting PJM electricity prices, and I've now been with True Light for a couple months now.
Hi, I'm Catherine. I've been with True Light for about 3 years. I work on our more of our data services and consulting side, where I work on maintaining our retail pricing models and providing data to clients.
Well, so that's the team here. We're ready to move into the next slide and start talking about the content. So what we're looking at here is the near-month natural gas futures prices. The quick takeaway here is that we did have a spike in our run-up back in January to kind of start off the winter. We all remember how cold that was, really across the entire swath of the eastern U.S. But really, since that period, you've had a run down and pretty much stable prices in that 250 to 270 range. Forward prices are kind of finding that nice little support at 250. If you look back to the maybe like a 2-year history back in early 2016, you can see that prices did get down to that $2 support level. Now projecting forward, where are we likely to be at? It's likely going to hold maybe closer to this 250 level. Could drop down to that $2 level like we saw in early 2016, but that's probably not the most likely outcome due to some other factors that we're seeing on the supply and demand side. This is kind of going to be the takeaway is that this is where the support's going to end up being for the summer, right around this 250 plus point. I'm ready for the next slide. Here we're looking at the natural gas spot prices. Again, that big run up in January. Gas, what we've really been seeing the trend being for the last couple of years due to the oversupply, really an overabundance of supply, is that gas is primarily becoming a winter trade, and you're really looking at the northeastern gas markets as driving that volatility, not so much due to a lack of supply, but more due to the lack of transmission, getting gas from where it's overly abundant, such as the Marcellus region in Pennsylvania and even the Utica Shale going out to Ohio and trying to access the more northeastern markets, such as New York and New England. But you can see just when there's really broad, cold, widespread across the whole U.S., dipping down into Texas, with Texas seeing, like when people are waking up and it's 30 degrees outside, that's pretty cold down for Texas, and that's when you see the Henry Hub spot price respond. And you can see how it got up into that $7 range a couple days in the late December, early January range. But since then, no real volatility. The spring has been quiet. The summer should look very quiet on Henry Hub for at least in terms of spot gas pricing. You might see a little bit more volatility in the northeastern points, like the Stony, like up in the Algonquin point this spring. We've seen some maintenance on the Stony Point compressor, and that's driven some volatility. But again, that's more of a transmission issue for gas, not so much supply. So on the supply front, we're actually looking pretty solid. And that's a good segue into the next slide. Here we're looking at the total supply and demand imbalance. Again, kind of tells the same story, but from a different perspective. When you had all that cold coming in January, that total consumption, which is effectively demand, that kind of pushes up the gas prices right around that late December, early January period, whereas total supply effectively remains constant. Since then, it's kind of evened out with total consumption matching supply a little bit better. At this point of the year, we expect that total consumption portion of the curve to begin dipping below total supply, and you can see that within kind of the last couple data points on the total consumption curve, how they did end up dipping below total supply, but in the very last couple, it's jumped back up over total supply. This is where we're seeing the trend of all that recent cold, lingering winter cold that has really characterized most of April for this part, really taking its impact and kind of pushing that consumption a little bit higher. And that sets us up a little bit lower on this storage front. Right now we're trailing below the 5-year average for storage, which means over the next several months, you're going to see a pretty strong, firm push for injections of gas into storage. That could have a bullish impact on gas prices on the forward curve, but overall, it's not, again, what's going to drive gas volatility isn't so much supply, but more the transmission. So as long as the transmission side of gas, especially in the Northeast, remains under control, there really shouldn't be too much of a price response until we get into the winter months and are on the watch for that large swath of cold hitting the U.S. That's a good point to transition to the next slide. Here we're looking at the short-term weather forecast, that 8 to 14-day outlook. This is published by the NOAA, made back on April 22nd. If this were to be more recent points, like today's forecast was come out within the last hour or so on some long-range weather models, it's actually showing a little bit of heat kind of pushing out into the East Coast. But right now, talking about the image in front of us, we are showing below normal temperatures along the East Coast. This is, again, kind of what we've been seeing the last couple of weeks with that cold sustaining in the east and really driving some residual heating demand that we don't typically see at this point in the spring anymore. But again, with the recent weather trends that we've been seeing unfold today and really even yesterday on those mid-range weather models, we're actually seeing a nice little ridge setting up in the Midwest that's going to push that cold out a little bit earlier than what NOAA was expecting a couple of days ago. And we're actually looking at next week, by the end of the week, we could even be seeing some temps getting up into the 80s in places like Philadelphia, and that would be paired with some humidity levels, like dew points getting up into the upper 50s, maybe even close to 60. So risk is really lining up more towards the upside, and kind of the takeaway is that even though we're showing below normals on the East Coast to start off next week, it could very much end next week as the opposite, with more heat, with some humidity, and that actually could make a pretty quick transition from this state of lingering cold winter heating demand, a very quick transition from that into more of your cooling demand profile as that early summer heat begins to take form a little bit quicker. It's going to be quite a volatile transition that we'll see unfold over the course of next week, and then we have a little bit of cold setting up for the weekend, but the week following, so really the second week of May, that's when the heat really begins to kick up again. And so you can see that early summer impact begin to take form. Obviously, the price impact from that on the gas side shouldn't be too much, maybe kind of keeps gas down in that 250 range for Henry Hub. But on the power side, you should see generally a lot of the eastern points begin to respond to that in the forward curve. And we are seeing some eastern power prices inch up forwards a little bit, not major changes week over week, but you should be seeing that press upwards in response to the incoming heat. So that about wraps up for the short-term weather. To move into the long-term weather forecast, we're looking at, and this is going to be your forecast again from the NOAA for the months of May, June, and July. Here, what you're looking at is the kind of the orange regions on the map of the U.S. That's denoting where we're expected to see above normal temperatures, and you can see really along the whole eastern coast. We're looking at above normal temperatures, which means a hotter than normal summer, and that's what we're looking at for PJM, New York, New England, even all the way down to ERCOT, where you're even seeing some more extreme heat risk out in the far west for Texas, which isn't unusual for Texas, but certainly above normal, so kind of sitting in the upper end of that probability frontier. But looking up into the Northeast, this is where we're seeing some interesting trends with that heat pretty much at this point as close to being locked in for New England as it can get. Again, there's a lot of variability with these long-range forecasts, so you have to take it with a considerable grain of salt. But pretty much all of New England seeing that firm above normal temperature risk. Even the eastern part of New York going down to the cities seeing that risk as well. And then if you look closely, you can even see areas like Newark and in northern New Jersey capturing some of that upside on temperatures as well. So whereas the rest of PJM is generally going to be pretty good chances of being above normal in temperatures. The northeastern reaches, which is like your Newark load centers, Trenton, maybe even closer down to Philadelphia, has some of that pretty strong strong heat risk, which would come in the form of cooling demand. So you should be seeing some real-time price potential or even in the day-ahead market, some price volatility potential. And so at this point where we're looking at right now on the forward curve, it looks like things could be trending upwards. And again, that's primarily due to the way that these weather forecasts are coming forward. So at this point right now that we're in that stable period of spring, about to transition into more summer heat-based springtime as we get into May, this could be the low point for the shoulder season. So forward curves should be moving upwards. They are already within the last week, and this would be the good point to lock in some prices on the retail side because things could be going up from here. So on that note, I'm going to hand it off to Catherine to talk a little bit more about the retail power pricing end of things.
So on the next slide, we have the Headroom spotlight for today's webinar. This is Headroom. This is for the blue line is the utility price for Potomac Edison, POTED, in Maryland for the general service small commercial rate class with their current price compared to what we expect based on current market conditions the cost of goods sold will be. And so that's saying that under the current conditions, there's headroom available where you could sell power at a savings to what the utility is offering under the current rates. POTED, moving on to the next slide. This is the history of how power prices have moved in the for POTED. This is POTED is part of the APS load zone, which is covers most of West Virginia as well as Potomac Edison in Maryland and some other small areas. But as in the last recent months, it's been climbing steadily, about 1% in the just over the last couple weeks, but the most recent peak was in January, and it's still quite below that, but has been prices have been climbing slightly recently for the POTED load zone. The next slide is looking at Houston, and I think Joe's going to speak to this one.
Yeah, so Houston, really ERCOT in general has been kind of on a roller coaster the last several months, and I think we've touched on it in earlier webinars how you have this really a terrific coincidence of high demand coming in through ERCOT as the system itself is expecting record-peaking or record-breaking demand for this summer, coinciding with a large group of generation retirements, like 4+ gigawatts of power has retired on the baseload side in ERCOT just in the last 6 months or so. So you're seeing an exit of stable baseload supply coinciding with very high demand, and that's what drove that run-up really throughout the whole back half of the winter and an early part of spring when we saw ERCOT prices really jump up. Now, within the last couple of weeks or so, a lot of that pressure has eased a little bit, and you've seen prices to begin to scale backwards, and they took a little bit of a dip on that, really on the kind of the last several data points for Houston. Within the last 2 weeks or so, I would say maybe even going back to 3 weeks, you've seen some of these generators which have been previously in a mothball status, which is to say that they are by all means effectively retired, but they can be called on and they can run if ERCOT says, hey guys, we really need you to ramp up today. So they're basically mothballed means that you're basically out of the stack, but you can come up in emergency type events. And so a lot of those generators, which the market previously was assuming were not going to be running or really available for the summer, several of them have announced that they are planning to come back into the stack either in mid-May or beginning June 1st. And so you've seen a slight improvement on the supply side on the ERCOT stack, and that has offers a good explanation as to why you've seen a little bit of a recent price dip. Now, what does that mean going forward for the 12-month strip for Houston, but even ERCOT this summer? Because that's really what the question we're really asking is, is this dip in prices really going to be representative of how we should be looking at ERCOT this summer? And the answer is, in short answer, maybe, but in long answer, no, because even though the stack is going to be improving a little bit, the overall risk profile for the way that ERCOT's going to be dispatching their resources on these high demand days doesn't change all too much. And you still have that risk of prices going in the real time up to $9,000. And ultimately what you're really just doing is making a bet on how many times ERCOT is going to have to dispatch these extreme resources up into that $9,000 price range. So even though you do get a little bit of recovery on the supply side, the overall risk doesn't change all too much. Maybe you get fewer of those hours. Maybe they're less intense. But overall, I think the market is maybe a little too quick to overreact and a little too responsive to that news of the return in generation. There still is some tremendous upside risk due to ERCOT because it still fundamentally remains weak on the supply side and high in terms of demand. And once you get some of those $9,000 prints coming through, there's really asymmetrical risk to the upside on for ERCOT pricing this summer. So I guess in short order, the best way to look at Houston pricing that we've been seeing it unfold in the last several months is that maybe that run up was a little bit overbought, got a little too expensive too quickly, but just in the same way, this dip is maybe a little bit too much oversold and is probably understating some of the very bullish factors that you should be considering with ERCOT this summer. So still some profoundly bullish risk down there, and I wouldn't look into that dip too much. And if anything, I would still be encouraging your customers or prospective clients to lock in their price now. Maybe that dip underscores how important it is to kind of lock that in at this point in time, because the fundamental risk still look profoundly bullish in ERCOT. And so that's about it for what we have on the slides here. To kind of put that all in context, I think we touched on ERCOT a little bit right there. Back to PJM and then the northeastern markets, what you're really looking at is that heat that we're going to be seeing driving that cooling demand and a little bit of bullish pressure on the forward curves. And right now, if you were to look at the forward curves for those eastern markets, you're going to generally find them increasing a little bit, as Catherine was saying earlier with Potomac Edison, but still at a relative low point where it's a good time to get in and probably lock in your pricing for the summer. And that's about all I have on the content we were discussing. Catherine, would you have anything else to add?
No, that kind of, I guess, brings up questions. If you have anything to ask us about what we've covered, general questions, anything.
Yeah, we'll give you guys a couple minutes to ask some questions either on the that GoToWebinar interface, and then actually none have popped up yet. So if you do have any questions on any of the content we discussed or anything else, now's the time to pop it in there, and then we'll get back to you in a minute or so with some answers. All right, so we've had a couple of questions come in, so just to touch on a few of them. So this one question was to clarify. It looks like it'll be pricing this. It looks like pricing will be going up this summer in New England and Texas. There's a pretty firm risk of that. Of course, things could not turn out the way that we're talking about it, so there's no 100% guarantee there. But from the fundamentals perspective, what we know to be certain now on our forecasts at least, things do have some considerable upside potential in New England. Not so much in New England as ERCOT. ERCOT is probably where you still have a lot of that volatility potential. The issue is the market obviously has priced a lot of that in, but provided that recent dip, that's probably where there's some opportunity or value to be found in the ERCOT forward market. So yes, there still is there's a risk of there's a strong risk of prices going up. That's probably where I would personally make my bet, but ultimately with the information we have in front of us, it's all uncertain. Forecasts can change, and there's no guarantee of that. Another question on ERCOT. High demand in ERCOT is only being related to higher projected temperatures or anything else. That's pretty much what that demand is going to correlate to. Without the temps and humidity showing up, you're not going to get that demand strength in ERCOT. But in terms of more of a long run analysis, you do have increased structural demand in ERCOT as well, especially out in the far west where there's day by day there's an increase in fracking and drilling activity, which drives up that baseload demand, and you see that. You certainly see some pricing impact from that as we see congestion occur out in the western side of market, which drives a lot of nodal price volatility, but ultimately doesn't quite hit the hubs or the load zones as much. So you don't see too much of that in the forward curves. But so I guess to answer that question in two parts, yes, temperatures are really the main reason why ERCOT summer demand is going to be high, but you also have year-over-year growth in that industrial demand. That's probably the best way to frame that ERCOT demand question. So that pretty much wraps up for the questions that we think we can answer now. We did get a few more that we'll have to we'll respond in the interface to those ones because it will require a little bit more analysis on our side. So, but as far as what we can answer now over the phone, that's probably going to wrap it up. But if you stay logged on, we'll shoot you some responses within the next several minutes on those questions. So Emily, I think that wraps up on our side.
All right. Well, I'd like to thank Catherine and Joe for sharing with us today and everyone for joining. If you have any questions that were not answered or think of anything else, just feel free to email your account manager or broker support at brokeronlineexchange.com. Thanks again, everyone, and we hope you join us next month.